Real estate math can be challenging, but Birdsey is here to help. In this video, we'll walk through the key math concepts you're likely to see on the exam. Each section includes real-world examples, like finding property values, calculating monthly payments, or handling fees. If you get stuck, no worries. Just find the code in the bottom corner of the screen and take it to birdsey.ai for real-time help. We'll tell you more about that in a minute. Now let's get started.
Let's start with a review of property valuation and appraisal. Price per square foot. Which calculation method would you use to determine the price per square foot of a property? Is it A, divide the total price of the property by the total square footage? B, multiply the total price of the property by the total square footage? C, add the total price of the property to the total square footage? Or D, subtract the total square footage from the total price of the property? The answer is A, divide the total price of the property by the total square footage. The price per square foot is determined by dividing the total price of the property by its total square footage, giving a standardized measure of cost per unit area. A property has a living area of 2,500 square feet and is valued at $350,000. What is the price per square foot? Is it A, $150, B, $125, C, $140, or D, $130? The answer is C, $140. To find the price per square foot, divide the total property value, $350,000, by the living area, 2,500 square feet, which results in $140 per square foot.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
A commercial property with 3,000 square feet is listed at $600,000. Calculate the price per square foot. Is it A, $190, B, $200, C, $180, or D, $210? The answer is B, $200. To determine the price per square foot, divide $600,000 by 3,000 square feet, resulting in $200 per square foot. An apartment has 1,200 square feet and is valued at $240,000. What is the price per square foot? Is it A, $220, B, $185, C, $200, or D, $196? The answer is C, $200. Calculate the price per square foot by dividing the total value of $240,000 by the area, 1,200 square feet, to get $200 per square foot. Straight-line depreciation. Which calculation would you use to determine the annual depreciation expense using the straight-line method? Is it A, divide the purchase price by the residual value, then multiply by the useful life? B, multiply the purchase price by the useful life, then add the residual value? C, add the residual value to the purchase price, then divide by the useful life? Or D, subtract the residual value from the purchase price, then divide by the useful life? The answer is D, subtract the residual value from the purchase price, then divide by the useful life. To determine the annual depreciation expense using the straight-line method, subtract the residual value from the purchase price of the asset, then divide the result by the useful life of the asset. A property is valued at $500,000 and is expected to depreciate at a straight-line rate of 2% annually over 10 years. What is the annual depreciation amount? Is it A, $10,000, B, $5,000, C. $15,000, or D. $20,000? The answer is A. $10,000. To calculate the annual depreciation, multiply $500,000 by 0.02, resulting in $10,000. A commercial property was purchased for $600,000 and has an estimated salvage value of $50,000 after a 30-year life. What is its annual straight-line depreciation? Is it A. $20,000, B. $18,500, C. $18,333.33, or D. $19,000? The answer is C. $18,333.33. Subtract the salvage value from the purchase price. $600,000 minus $50,000 equals $550,000. Then divide by the 30-year life. $550,000 divided by 30 equals $18,333.33. A building is valued at $500,000 and is expected to depreciate over a useful life of 25 years using straight-line depreciation. What is the annual depreciation amount? Is it A. $20,000, B. $18,000, C. $25,000, or D. $15,000? The answer is A. $20,000. To calculate annual depreciation, divide the value by the useful life. $500,000 divided by 25 equals $20,000.
Stuck on a question? Just think of the Birdsey link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Gross rent multiplier. Which calculation method would you use to determine the gross rent multiplier for a property? Is it A. Add the property price to the gross annual rental income, B. Multiply the property price by the gross annual rental income, C. Subtract the gross annual rental income from the property price, or D. Divide the property price by the gross annual rental income? The answer is D. Divide the property price by the gross annual rental income. To calculate the gross rent multiplier, you divide the property price by the gross annual rental income. A property generates a monthly rent of $2,500 and is sold for $300,000. What is the gross rent multiplier? Is it A. 10, B. 15, C. 25, or D. 30? The answer is A. 10. To find the gross rent multiplier, GRM, first calculate the annual rent. $2,500 multiplied by 12 equals $30,000. Then divide the property price by the annual rent. $300,000 divided by $30,000 equals 10. A property is purchased for $500,000 and the annual rental income is $50,000. What is the gross rent multiplier? Is it A. 10, B. 20, C. 15, or D. 5? The answer is A. 10. To find the gross rent multiplier, GRM, divide the purchase price by the annual rental income. $500,000 divided by $50,000 equals 10. The annual rental income for a property is $80,000 and the purchase price was $640,000. What is the gross rent multiplier? Is it A. 6, B. 7, C. 8, or D. 10? The answer is C. 8. To find the gross rent multiplier, GRM, divide the purchase price by the annual rental income. $640,000 divided by $80,000 equals 8. Capitalization rate. Which calculation method would you use to determine the capitalization rate for a property? Is it A. Divide the net operating income by the current market value of the property. B. Multiply the net operating income by the current market value of the property. C. Subtract the net operating income from the current market value of the property. Or D. Add the net operating income to the current market value of the property. The answer is A. Divide the net operating income by the current market value of the property. The correct method to calculate the capitalization rate is by dividing the net operating income by the current market value of the property. This provides a percentage that indicates the expected return on investment. A rental property generates an annual net operating income of $50,000. The capitalization rate in the area is 5%. What is the estimated value of the property? Is it A, $2,500,000, B, $900,000, C, $1,100,000, or D, $1 million? The answer is D, $1 million. The value is calculated by dividing $50,000 by 0.05 cap rate, resulting in $1 million. A property has a market value of $500,000 and generates a net operating income of $40,000 yearly. What is the capitalization rate for this property? Is it A, 9%, B, 8%, C, 10%, or D, 11%? The answer is B, 8%. To find the cap rate, divide the net operating income, NOI, by the property's market value. $40,000 divided by $500,000 equals 0.08 or 8%. A property has an annual net operating income of $50,000. If the capitalization rate is 5%, what is the estimated value of the property? Is it A, $1 million, B, $950,000, C, $1,050,000, or D, $900,000? The answer is A, $1 million. To calculate the property value, divide the net operating income, NOI, by the capitalization rate. $50,000 divided by 0.05 equals $1 million.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Now let's work on loan calculations and financing. Loan-to-value ratios. Which calculation would you use to determine the loan-to-value ratio for a property? Is it A, add the loan amount to the property value, B, multiply the loan amount by the property value, C, divide the loan amount by the property value, or D, subtract the loan amount from the property value? The answer is C, divide the loan amount by the property value. To calculate the LTV ratio, divide the loan amount by the property value and typically express it as a percentage. A property is valued at $350,000 and the loan amount is $280,000. Calculate the loan-to-value ratio. Is it A, 80%, B, 75%, C, 85%, or D, 90%? The answer is A, 80%. The loan-to-value ratio is calculated by dividing the loan amount by the property value and multiplying by 100 to get a percentage. $280,000 divided by $350,000 multiplied by 100 equals 80%. A property is valued at $500,000 and the buyer takes out a loan for $400,000. Calculate the loan-to-value ratio. Is it A, 60%, B, 80%, C, 75%, or D, 85%? The answer is B, 80%. The loan-to-value ratio is calculated by dividing the loan amount by the property value and multiplying by 100. $400,000 divided by $500,000 multiplied by 100 equals 80%. A property is valued at $600,000 and the loan taken is for $540,000. Calculate the loan-to-value ratio. Is it A, 88%, B, 82%, C, 90%, or D, 85%? The answer is C, 90%. The loan-to-value (LT) ratio is calculated by dividing the loan amount by the property value and multiplying by 100. $540,000 divided by $600,000 multiplied by 100 equals 90%. Points and origination fees. How would you determine the amount of origination fees for a loan? Is it A, subtract the origination fee percentage from the loan amount, B, add the loan amount to the origination fee percentage, C, divide the loan amount by the origination fee percentage, or D, multiply the loan amount by the origination fee percentage? The answer is D, multiply the loan amount by the origination fee percentage. To calculate origination fees, multiply the loan amount by the origination fee percentage. A homeowner is refinancing their loan amount of $350,000 with 2 origination points. What is the total cost for the origination fees? Is it A, $7,000, B, $3,500, C, $10,500, or D, $5,250? The answer is A, $7,000. Origination fees are 2% of $350,000, so the cost is $350,000 multiplied by 0.02, which equals $7,000. A mortgage loan is for $500,000 with 1.5 discount points being paid. What is the total amount for the discount points? Is it A, $5,000, B, $7,500, C, $10,000, or D, $2,500? The answer is B, $7,500. Discount points are 1.5% of $500,000, so the cost is $500,000 multiplied by 0.015, which equals $7,500. A borrower takes out a $250,000 loan with 1% in origination fees. How much does the borrower pay in origination fees? Is it A, $3,750, B, $5,000, C, $2,500, or D, $7,500? The answer is C, $2,500. Origination fees are 1% of $250,000, so the fee is $250,000 multiplied by 0.01, which equals $2,500. Simple interest rate calculations. Which method would you use to determine the simple interest earned on a savings account? Is it A, divide the principal amount by the interest rate and multiply by the time period, B, multiply the principal amount by the interest rate and the time period, C, add the principal amount to the interest rate and multiply by the time period, or D, subtract the interest rate from the principal amount and multiply by the time period? The answer is B, multiply the principal amount by the interest rate and the time period. To calculate simple interest, multiply the principal amount by the interest rate and the time period. A borrower takes out a loan of $50,000 with an annual simple interest rate of 5%. What is the total interest paid after 3 years? Is it A, $7,500, B, $6,000, C, $8,000, or D, $10,000? The answer is A, $7,500. Using the simple interest formula, interest equals principal times rate times time, $50,000 times 0.05 times 3 equals $7,500. If a loan amount is $75,000 at a simple interest rate of 4% annually, what will be the total amount to be repaid after 5 years? Is it A, $91,500, B, $90,000, C, $85,000, or D, $100,000? The answer is B, $90,000. Using the simple interest formula, interest equals principal times rate times time. $75,000 times 0.04 times 5 equals $15,000. The total repayable is $75,000 plus $15,000, which equals $90,000. A person invests $10,000 at an annual simple interest rate of 3%. How much interest does he earn after 4 years? Is it A, $11,200, B, $1,500, C, $1,200, or D, $1,000? The answer is C, $1,200. Using the simple interest formula, interest equals principal times rate times time, $10,000 times 0.03 times 4 equals $1,200.
Notice the code in the corner. When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Basic amortization. How would you determine the monthly payment on a fixed-rate mortgage using amortization? Is it A, divide the loan amount by the number of payments, B, multiply the interest rate by the loan amount, then add the loan term, C, use the amortization formula to include the loan amount, interest rate, and number of payments, or D, subtract the interest rate from the loan amount? The answer is C. Use the amortization formula to include the loan amount, interest rate, and number of payments. To determine the monthly payment on an amortized loan, you use the amortization formula, which considers the loan amount, interest rate, and the total number of payments, loan term. A loan of $250,000 is taken out with an annual interest rate of 4% for 30 years. What is the monthly payment? Is it A, $1,193, B, $1,225, C, $1,150, or D, $1,275? The answer is A, $1,193. For a $250,000 loan at 4% per year over 30 years, first divide 4% by 12 to get the monthly rate. Then, plug that rate, the loan amount, and the total of 360 months into the amortization formula. The result is about $1,193 per month. Calculate the monthly payment for a $300,000 loan with an annual interest rate of 3.5% amortized over 15 years. Is it A, $2,200, B, $2,149, C, $2,250, or D, $2,340? The answer is B, $2,149. To convert 3.5% per year to a monthly rate, 3.5 divided by 12 equals approximately 0.2917%, or 0.002917 as a decimal. With 180 payments, 15 years times 12 months, the monthly payment is approximately $2,149. A property is purchased with a $200,000 loan at an interest rate of 5% per annum, amortized over 20 years. What is the monthly payment? Is it A, $1,520, B, $1,456, C, $1,320, or D, $1,400? The answer is C, $1,320. To convert 5% per year to a monthly rate, 5 divided by 12 equals approximately 0.4167%, or 0.004167 as a decimal. With 240 payments, 20 years times 12 months, the monthly payment is approximately $1,320. Now let's review area and square footage calculations. Lot size and square footage. Which calculation would you use to determine the square footage of a property given its length and width? Is it A, multiply the length by the width, B, add the length to the width, C, divide the width by the length, or D, subtract the width from the length? The answer is A, multiply the length by the width. To calculate the square footage, you multiply the length of the property by its width, thus obtaining the area. A rectangular lot measures 150 feet by 200 feet. What is the total square footage of the lot? Is it A, 25,000 square feet, B, 30,000 square feet, C, 28,000 square feet, or D, 32,000 square feet? The answer is B, 30,000 square feet. Multiply the length and width, 150 feet times 200 feet equals 30,000 square feet. A triangular lot with a base of 80 feet and a height of 60 feet. Calculate the area of the lot in square feet. Is it A, 3,400 square feet, B, 2,400 square feet, C, 2,700 square feet, or D, 3,000 square feet? The answer is B, 2,400 square feet. The formula for the area of a triangle is 1/2 times base times height. 1/2 times 80 times 60 equals 2,400 square feet. A rectangular plot of land measures 150 feet in width and 200 feet in length. What is the total square footage of this lot? Is it A, 30,000 square feet, B, 35,000 square feet, C, 25,000 square feet, or D, 28,000 square feet? The answer is A, 30,000 square feet. To find the total square footage, multiply the width, 150 feet, by the length, 200 feet, giving you 30,000 square feet. Usable gross building area. How would you determine the usable building area from the gross building area? Is it A, divide the gross building area by the usable area percentage, B, add the non-usable areas to the gross building area, C, multiply the gross building area by the non-usable area percentage, or D, subtract the non-usable areas from the gross building area? The answer is D, subtract the non-usable areas from the gross building area. To find the usable building area, you need to subtract all non-usable spaces, such as hallways, mechanical rooms, and other service areas, from the gross building area. An office building has a gross building area of 20,000 square feet. If the usable area is 85% of the gross area, what is the usable area? Is it A, 17,000 square feet, B, 16,000 square feet, C, 15,500 square feet, or D, 18,000 square feet? The answer is A, 17,000 square feet. To calculate the usable area, multiply the gross area, 20,000, by 0.85. This equals 17,000 square feet. A building has a gross area of 15,000 square feet, but only 12,000 square feet is considered usable. What percentage of the building is usable? Is it A, 80%, B, 85%, C, 90%, or D, 75%? The answer is A, 80%. To find the usable percentage, divide 12,000 by 15,000, resulting in 0.8 or 80%. A commercial property has a gross building area of 20,000 square feet and a usable area of 16,000 square feet. Calculate the percentage of non-usable area. Is it A, 20%, B, 15%, C, 25%, or D, 30%? The answer is A, 20%. The non-usable area is 20,000 minus 16,000, which is 4,000. Divide 4,000 by 20,000 and multiply by 100 to get 20%.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Now let's spend some time reviewing prorations and adjustments. Unless otherwise stated in these questions, assume you will be doing calculations based on days. Prorating property taxes. Which method would you use to prorate property taxes in a real estate transaction? Is it A, divide the annual tax amount by the number of months, then multiply by the total number of months in the year? B, determine the daily tax rate and multiply it by the number of days the seller owned the property? C, subtract the total tax amount from the sale price? Or D, add the tax amount to the purchase price and then divide by 2? The answer is B, determine the daily tax rate and multiply it by the number of days the seller owned the property. To prorate property taxes, you typically calculate the daily tax rate and multiply it by the number of days the seller owned the property to determine the seller's share. This ensures taxes are fairly split between buyer and seller based on ownership during the tax year. A property with annual property taxes of $3,650 is sold on June 20th. The seller owes taxes up to, but not including, the day of sale. Using a 365-day year, how much does the seller owe in prorated property taxes? Is it A, $1,800, B, $1,500, C, $1,700, or D, $1,850? The answer is C, $1,700. To calculate the daily rate, divide $3,650 by 365, which equals $10 per day. Count 170 days from January 1st to June 19th. Multiply $10 per day by 170 days, which equals $1,700. A buyer takes possession on September 5th of a property with annual taxes of $4,200, already paid in full by the seller. Using a 365-day year and rounding to the nearest dollar, how much should the buyer reimburse the seller for the remaining part of the year? Is it A, $1,360, B, $1,655, C, $1,620, or D, $1,750? The answer is A, $1,360. To calculate the daily rate, divide $4,200 by 365, which equals approximately $11.51 per day. There are 118 days remaining, September 5th through December 31. Multiply $11.51 by 118, which equals approximately $1,358. Rounded to the nearest dollar, the total is $1,360. A property has annual property taxes of $5,500. The sale closes on October 15th, and the seller owes taxes through October 14th. Using a 360-day year, 30 days per month, how much does the seller owe? Is it A, $4,340, B, $3,850, C, $4,150, or D, $3,950? The answer is A, $4,340. To calculate the daily rate, divide $5,500 by 360, which equals approximately $15.28 per day. From January 1st to October 14 is 284 days. 9 months at 30 days each equals 270 days, plus 14 days in October. Multiply $15.28 by 284, which equals approximately $4,342. Rounded to the nearest dollar, The total is $4,340. Prorating HOA fees. Which calculation would you use to prorate HOA fees for a property that is sold mid-month? Is it A, multiply the annual HOA fee by the number of days the seller owns the property in the month, and then divide by the total number of days in the year? B, multiply the monthly HOA fee by the number of days the seller owns the property in the month, then divide by the number of days in that month. C, divide the monthly HOA fee by 12, then multiply by the total number of days in the month. Or D, subtract the monthly HOA fee from the number of days the seller owns the property. The answer is B, multiply the monthly HOA fee by the number of days the seller owns the property in the month, then divide by the number of days in that month. To prorate HOA fees for a sale occurring mid-month, compute the daily rate by dividing the monthly fee by the number of days in that particular month. Then, multiply this daily rate by the number of days the seller owned the property in that month. A condo has an annual HOA fee of $5,400. The property is sold on the 150th day of the year. Calculate the prorated HOA fee the seller is responsible for, assuming a 365-day year. Is it A, $2,100, B, $2,219, C, $2,475, or D, $2,500? The answer is B, $2,219. To calculate the proration, divide $5,400 by 365, which equals approximately $14.79 per day. Multiply $14.79 by 150 days, which equals $2,219. A townhouse has monthly HOA dues of $200 and the sale closes on March 20th. Calculate the amount the buyer owes for the remaining days of March if March has 31 days. Is it A, $62.58, B, $100, C, $70.97, or D, $86.67? The answer is C, $70.97. To calculate the daily proration, divide $200 by 31 days, which equals approximately $6.45 per day. Multiply $6.45 by 11 days, which equals approximately $70.97. The annual HOA fee for a gated community is $3,600. If the property is sold on the 270th day of a leap year, how much of the HOA fee is the seller responsible for? Is it A, $2,656, B, $2,575, C, $2,600, or D, $2,820? The answer is A, $2,656. To find the seller's responsibility, divide $3,600 by 366 days, leap year, which equals approximately $9.83 per day. Multiply $9.83 by 270 days, which equals approximately $2,656.
Notice the code in the corner? When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Prorating rent income. Which calculation method would you use to prorate rent income when a tenant moves in mid-month? Is it A, multiply the full rent amount by the percentage of the month the property is occupied? B, divide the full rent amount by the number of occupied days? C, add the full rent amount to the occupancy percentage? Or D, subtract the number of non-occupied days from the full rent amount? The answer is A, multiply the full rent amount by the percentage of the month the property is occupied. To prorate rent income, you multiply the full monthly rent by the percentage of the month the tenant occupies the property. A tenant pays $1,500 monthly rent for an apartment. The lease starts on February 1st. The tenant decides to vacate the apartment, and the lease will end on February 10th. Using a 30-day month basis, how much rent should be prorated and refunded to the tenant? Is it A, $500, B, $1,000, C, $1,200, or D, $900? The answer is B, $1,000. The tenant pays $1,500 for a 30-day month. Since they occupy only 10 days, they should be refunded for the remaining 20 days. $1,500 divided by 30 days equals $50 per day. Multiply $50 by 20 days, which equals $1,000. A landlord receives $2,400 as monthly rent from a property. The tenant moves out on the 15th of the month. Using daily proration in a 30-day month, how much rent should the tenant pay for their last month? Is it A, $1,200, B, $1,000, C, $1,500, or D, $2,400? The answer is A, $1,200. The monthly rent is $2,400 for a 30-day month. The tenant pays for 15 days. $2,400 divided by 30 days equals $80 per day. Multiply $80 by 15 days, which equals $1,200. A landlord receives $1,200 monthly rent for a property. The property is sold, and closing occurs on the 15th of a 30-day month. How much rent income should be prorated to the seller? Is it A, $900, B, $700, C, $800, or D, $600? The answer is D, $600. To prorate the rent, divide $1,200 by 30 days, then multiply by 15 days, resulting in $600. Let's work on some commission calculations. Sales commission percentages. Which method would you use to determine the sales commission if you know the total sale amount and commission percentage? Is it A, multiply the total sale amount by the commission percentage, B, subtract the commission percentage from the total sale amount, C, divide the commission percentage by the total sale amount, or D, add the total sale amount to the commission percentage? The answer is A, multiply the total sale amount by the commission percentage. To calculate the commission, multiply the total sale amount by the commission percentage, as this calculation provides the commission value directly from the sale. An agent sells a property for $500,000 and the commission rate is 5%. What is the total commission amount? Is it A, $20,000, B, $25,000, C, $30,000, or D, $22,500? The answer is B, $25,000. To find the commission, multiply $500,000 by 0.05, which equals $25,000. A real estate agent has a listing that sells for $750,000. The commission rate is 4.5%. What is the agent's commission? Is it A, $33,750, B, $34,500, C, $33,000, or D, $32,250? The answer is A, $33,750. Multiply $750,000 by 0.045 to find the commission, which results in $33,750. A property sells for $350,000 with a commission rate of 5%. What is the commission amount? Is it A, $17,500, B, $14,000, C, $21,000, or D, $15,000? The answer is A, $17,500. To calculate the commission, multiply $350,000 by 0.05, which equals $17,500. Basic commission splits, agent-broker. Which calculation would you use to determine the agent's commission from the total commission earned on a sale? Is it A, multiply the total commission by the agent's commission split percentage? B, divide the total commission by the agent's commission split percentage? C, add the total commission to the agent's commission split percentage? Or D, subtract the agent's commission split percentage from the total commission? The answer is A, multiply the total commission by the agent's commission split percentage. To determine the agent's commission, multiply the total commission by the agent's commission split percentage. Which calculation would you use to determine the agent's commission share when working with a broker? Is it A, add the agent's commission percentage to the sale price? B, divide the total commission by the agent's commission split percentage? C, subtract the broker's commission from the total sale price? Or D, multiply the total commission by the agent's commission split percentage? The answer is D, multiply the total commission by the agent's commission split percentage. To find the agent's commission share, multiply the total commission by the agent's percentage of the commission split. How would you determine the commission share for an agent if the total commission from a sale is known and a specific split is agreed with the broker? Is it A, multiply the total commission by the agent's split percentage? B, divide the total commission by the agent's split percentage? C, subtract the agent's split percentage from the total commission? Or D, add the agent's split percentage to the total commission? The answer is A, multiply the total commission by the agent's split percentage. To find the agent's share of the commission, you multiply the total commission by the agent's split percentage. Which method would you use to determine the commission split between an agent and a broker based on the total commission earned from a property sale? Is it A, add the agent's split percentage to the total commission? B, multiply the total commission by the broker's split percentage? C, multiply the total commission by the agent's split percentage? Or D, divide the total commission by the agent's split percentage? The answer is C, multiply the total commission by the agent's split percentage. To calculate the agent's share of the commission, you multiply the total commission by the agent's split percentage. We'll continue now with closing and settlement costs. Basic closing costs. Which calculation would you use to determine the total closing costs for a buyer in a real estate transaction? Is it A, subtract the down payment from the property sale price? B, multiply the property sale price by a fixed closing cost percentage? C, add the loan origination fee, appraisal fee, title insurance, and other applicable fees? Or D, divide the total fees by the number of payment installments? The answer is C, add the loan origination fee, appraisal fee, title insurance, and other applicable fees. To calculate the total closing costs, you typically sum up all related fees such as the loan origination fee, appraisal fee, and title insurance. A property sells for $250,000 with a commission rate of 5%. What is the commission amount? Is it A, $12,500, B, $10,000, C, $15,000, or D, $13,500? The answer is A, $12,500. To calculate the commission, multiply $250,000 by 0.05, which equals $12,500. The annual property taxes are $3,600. If the property is sold with 3 months remaining, what is the prorated tax amount for the buyer? Is it A, $1,200, B, $900, C, $600, or D, $750? The answer is B, $900. To calculate the prorated taxes for 3 months, divide $3,600 by 12 months, which equals $300 per month. Multiply $300 by 3 months, which equals $900. The closing costs for a property purchase, including a 3% fee of the sale price of $300,000 and fixed fees totaling $2,500, need to be calculated. What is the total closing cost? Is it A, $11,500, B, $10,000, C, $9,000, or D, $11,000? The answer is A, $11,500. To calculate the percentage fee, multiply $300,000 by 0.03, which equals $9,000. Add the fixed fees of $2,500, resulting in a total closing cost of $11,500. Prorated expenses. Which calculation would you use to determine the prorated share of yearly property taxes for a seller who sells mid-year? Is it A, calculate the daily tax rate and multiply it by the number of days the seller owned the property? B, subtract the total property tax from the sale price? C, multiply the yearly property tax by the total days in a year? Or D, divide the yearly property tax by 12 and multiply by the number of remaining months in the year? The answer is A, calculate the daily tax rate and multiply it by the number of days the seller owned the property. You need to calculate the daily tax rate first, then multiply by the number of days the seller owned the property. How would you determine the prorated expense amount when splitting a property tax bill between the buyer and seller during a real estate transaction? Is it A, multiply the total tax amount by the number of days the seller owned the property and divide by 365? B, divide the total tax amount by 365 days to find the daily rate, then multiply by the number of days each party owns the property? C, divide the total tax amount by 12 months, then multiply by the number of months the property was owned? Or D, subtract the seller's ownership days from 365 and multiply by the daily rate? The answer is B, divide the total tax amount by 365 days to find the daily rate, then multiply by the number of days each party owns the property. To prorate expenses like property taxes, you first calculate the daily rate by dividing the total tax amount by 365 days, then apply this daily rate to the number of days each owner held the property during the billing period. A property has annual property taxes of $3,600. The transaction closes on the 150th day of a 360-day year, with the seller responsible for taxes up to, but not including, the day of closing. How much tax is the seller responsible for? Is it A, $1,490, B, $1,800, C, $1,200, or D, $2,700? The answer is A, $1,490. Annual taxes are $3,600, and using a 360-day year gives a daily rate of $10. Since the seller pays up to but not including the 150th day, that's 149 days. 149 multiplied by $10 equals $1,490. How would you determine the seller's share of property tax for the year in a prorated expense situation? Is it A, calculate the total annual property tax and divide it by the number of days in the year, then multiply by the number of days the seller owned the property? B, divide the total annual property tax by the number of months in the year, then subtract the number of months the seller owned the property? C, multiply the total annual property tax by the number of months the seller owned the property, and then divide by 12? Or D, subtract the total property tax from the number of days the seller lived in the property? The answer is A. Calculate the total annual property tax and divide it by the number of days in the year, then multiply by the number of days the seller owned the property. To calculate the seller's share of property tax in a prorated expense situation, determine the daily portion by dividing the annual tax by the number of days in a year, then multiply by the number of days the seller actually owned the property.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Net proceeds calculation for buyers and sellers. Which calculation would you use to determine the net proceeds for a seller in a real estate transaction? Is it A. Divide the sale price by the remaining mortgage balance? B. Add the sale price to the closing costs? C. Multiply the sale price by the total closing costs? Or D. Subtract total closing costs and remaining mortgage balance from the sale price? The answer is D. Subtract total closing costs and remaining mortgage balance from the sale price. To calculate net proceeds for a seller, start with the sale price and subtract both the total closing costs and any outstanding mortgage balance. Which calculation method would you use to determine the net proceeds for a seller? Is it A. Subtract total selling expenses from the sale price? B. Add total selling expenses to the sale price? C. Multiply total selling expenses by the sale price? Or D. Divide the sale price by total selling expenses? The answer is A. Subtract total selling expenses from the sale price. To determine the net proceeds for a seller, subtract all selling expenses from the sale price. This ensures that all costs associated with the sale are accounted for, leaving the net amount the seller receives. Which calculation would you use to determine the net proceeds for a seller after a home sale? Is it A. Add selling expenses to the sale price? B. Multiply the sale price by the total expenses? C. Subtract selling expenses from the sale price? Or D. Divide the sale price by the selling expenses? The answer is C. Subtract selling expenses from the sale price. To calculate net proceeds, one must subtract all expenses incurred during the sale from the sale price. This gives the seller the actual profit received after sale costs. Which method would you use to calculate the net proceeds for a seller in a real estate transaction? Is it A. Subtract all transaction costs from the sale price? B. Add all transaction costs to the sale price? C. Multiply the sale price by the total transaction costs? Or D. Divide the sale price by the total transaction costs? The answer is A. Subtract all transaction costs from the sale price. To calculate the net proceeds for a seller, you subtract all transaction costs from the sale price. This gives the amount the seller will receive after covering all expenses related to the sale. In our final section, we'll review real estate taxes and assessments. Basic property tax calculation. How would you determine the amount of property tax owed for a property? Is it A. Multiply the assessed value of the property by the tax rate and divide by 100? B. Divide the assessed value of the property by the tax rate and multiply by 100. C. Add the assessed value of the property to the tax rate. Or D. Subtract the tax rate from the assessed value of the property. The answer is A. Multiply the assessed value of the property by the tax rate and divide by 100. To determine the property tax, you multiply the assessed value by the tax rate, typically expressed as a mill rate, then divide by 100 to calculate the amount owed. A property is valued at $500,000 with an annual property tax rate of 1.2%. What is the annual property tax amount? Is it A. $5,000, B. $6,000, C. $5,500, Or D, $7,000? The answer is B, $6,000. To calculate the property tax, multiply $500,000 by 0.012, resulting in $6,000. A property has an assessed value of $300,000. If the annual property tax rate is 2%, calculate the monthly property tax payment. Is it A, $625, B, $600, C, $550, or D, $500? The answer is D, $500. Calculate the annual property tax. Multiply $300,000 by 0.02, which equals $6,000. To find the monthly payment, divide $6,000 by 12, which equals $500 per month. A property has annual property taxes of $3,600. Assume a 360-day year. The property is sold on day 150 of the year, and the buyer is responsible for taxes starting on day of closing. How much tax is the buyer responsible for? Is it A, $1,500, B, $2,100, C, $2,000, or D, $2,500? The answer is B, $2,100. The annual tax is $3,600, so at $10 per day, based on a 360-day year, the buyer covers days 151 through 360, totaling 210 days. Multiply 210 days by $10 per day, which equals $2,100.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.